Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
It's the start of another exciting week. Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Over the last few years, it's been an amazing journey for me. No, I'm not talking about COVID-19, all right? I'm talking about fatherhood. My 3-year-old boy has been my best teacher. He's been giving me a completely new perspective in my life. So over this weekend, I saw him playing with building blocks, and he was attempting to build a tall tower, but he did not put enough base. So the tower eventually collapsed after getting to a certain height. Now, in the financial markets, we've been hearing a lot from clients lately. Is the US equities rally the real deal? Or is this a bear market rally? So certainly the latest few data prints in the US have been encouraging. The second quarter earnings season has been reasonable. NFP continued to be strong. CPI and PPI were below expectations. And US retail sales holding up so far. But is this enough base for the market to rally further? Well, so this week we'll have more clues. On Tuesday, US time, you'll be seeing manufacturing PMI being released. And on Wednesday, you'll be getting advanced reports on durable goods manufacturers' shipments, inventories, and orders for the month of July. This tracks big-ticket items. And finally, at the end of this week, we will have Jay Powell's speech at the annual Jackson Hole meeting, where investors will be looking for clues on the pace of future interest rate hikes. So looking at the index, S&P 500 has rallied by more than 15% from the bottom this year. Is it going to continue further? That's the big question. Well, if the growth and inflation mix continue to be favorable, it may well go higher from here. But let's take a look at the chart. It hit the 200-day moving average resistance, which was at 43.25, and then it turned south. And there's minor resistance at 4417, which was reached once in early March this year. And 4600 is the biggie. We hit that level 3 times in the first quarter this year, and the bulls failed to conquer that level. So in our opinion, it does make sense for investors to have a barbell approach in case we get any derailing on the growth front, or indeed we have inflation picking up again on the upside. US 10-year yield has been grinding higher, making high highs and high lows, recovering from the lows at 2.5. So in our opinion, it makes sense for investors to be rotating some of their US equities into global fixed income. If US 10-year yield goes to 3% or 3.25% level. Global fixed income, as we said, is very much on offer with yield levels at 10-year highs in various sub-asset classes, such as global IG and global high yield. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.